John Keel's Holdings, the largest publicly listed company on the Colombo Stock Exchange, just closed the year where two of the biggest bets in its 150-year history finally went live. I'm going to spend the next 15 minutes pulling apart how the group got here, the vision behind it, the environment it's competing in, the strategic choices it made, and whether the numbers back up the story. Everything here is drawn from JKH's annual report 2024-25, the year ended 31 March 2025. I'll flag clearly where I'm reporting a stated fact versus where I'm offering my own read on it. Environment JKH is competing in, how competitive strategy plays out differently across its business units, the timing and scope of this year's biggest strategic moves, execution and diversification across the portfolio, the people, culture, and leadership behind the strategy, and finally, the financial results, reported and underlying. 7 angles, 1 company. Let's start with where the strategy comes from. JKH doesn't publish a punchy one-line vision statement the way a startup might. What it has instead is a 150-year-old operating philosophy. Started in the 1870s as a produce and exchange broking house, and the through line since then has been constant realignment toward whatever the growth sector of the era is. That's not incidental, it's the strategic direction. The annual report frames the current chapter under the theme Ready, Set, Go. Investments that were blueprints are now live ventures. 2 moves anchor that direction this year: the City of Dreams, Sri Lanka, integrated resort, and the West Container Terminal at the Port of Colombo. Both are described by the chairperson as among the largest investments in the group's history, positioned to reinforce Sri Lanka as a regional leisure and logistics hub. What's notable strategically is the stated investment philosophy underpinning all of this: a positive outlook, a bold approach, commitment to delivery, and flexibility to change, sitting alongside a stated commitment to governance, integrity, and multi stakeholder responsibility. That's the corporate parenting logic in a single sentence. The center exists to allocate capital boldly across a portfolio while holding every business to the same governance bar. Externally, this was actually a favorable year to be a Sri Lankan conglomerate. GDP grew 5% in CY 2024, the strongest since 2017. The sovereign rating was upgraded in December 2024 after debt restructuring, marking exit from default status. Interest rates stayed below 10%, inflation was negative for most of the year, and the rupee appreciated roughly 11% against the dollar. Tourist arrivals were up 38% year on year. Politically, presidential, parliamentary, and local government elections all concluded, which the report frames as removing a layer of uncertainty for policy continuity. That's the macro tailwind. But there's nuance. The report confirms a stronger rupee actually hurt some JKH businesses. It eroded the translated value of dollar denominated interest income at the holding company. And the report separately confirms rupee appreciation translation impact contributed to margin contraction at Lanka Marine Services, the group's bunkering business. My own read on that: the same macro trend was a tailwind for tourism linked units and a headwind for others, which is a useful illustration of why a diversified portfolio smooths out currency and cyclical exposure that a single industry firm can't. That's my interpretation of the pattern, not a claim the report makes explicitly. Internally, the resource base is what you'd expect from an incumbent conglomerate: an 86 entity balance sheet capable of funding a $450 million container terminal and a resort with hundreds of millions in capital cost. The Cinnamon hospitality brand, leadership in supermarket retail, a majority owned digital bank adjacent stockbroker, and a 24% ROE bank in Nations Trust, and Octave, its in house advanced analytics practice, which has moved from internal pilots into selling analytics services externally in the UK. That capability, proprietary data science sold as a product, is a genuine differentiator competitors can't easily replicate. Competitiveness wise, JKH was ranked the most respected entity in Sri Lanka for a 19th consecutive year and scored full marks 4 years running on corporate transparency. That reputational capital is itself a resource. It lowers the cost of capital and eases stakeholder trust in bold, capital intensive bets like CodeSL. JKH doesn't run one competitive strategy because it isn't one business. This is where Porter's generic strategies get interesting applied at a conglomerate level. Different business units are pursuing different generic strategies simultaneously, and the parent's job is portfolio level allocation, not picking one stance. In leisure is differentiation, the cinnamon brand, the scale of City of Dreams, and bringing in Melco, a globally recognized integrated resort operator, as a $125 million co-investor and brand partner, rather than trying to build casino and integrated resort expertise from scratch. In supermarkets, it's closer to a broad differentiation with cost discipline play. Same-store sales grew 14.2%, which the report attributes to footfall growth from both existing and new customers, continued conversion from general trade to modern trade, economies of scale, and the Nexus loyalty program as several contributing factors rather than one single driver. Separately, margin improvement versus competitive is attributed to advanced analytics initiatives applied across supply chain, marketing, and daily operations, plus a distribution center built for roughly 250 outlet scale that gives the business room to keep expanding without replatforming logistics. In the new electric vehicle business, JKH is entering via partnership rather than competing head on with an established brand, partnering with BYD, the world's largest EV manufacturer, to import and distribute rather than manufacture. That's a classic market entry strategy. Leverage an external capability gap by partnering rather than building. And in ports, WCT1 is a first mover play on deep water automated capacity aimed squarely at capturing Red Sea disruption driven transshipment volumes shifting toward Colombo, a capacity based competitive strategy rather than a pricing one. Timing is where this year's story gets genuinely interesting because 2-decade-long bets landed in the same 12 months. City of Dreams, Sri Lanka, 10 plus years in construction, opened its hotel component in October 2024, with the casino and second hotel scheduled for August 2025. WCT1 began commercial operations in the fourth quarter of the financial year, February 2025. That's a scope decision as much as a timing one. JKH chose to concentrate two of its largest ever capital commitments into overlapping completion windows, which concentrates execution risk but also means the earnings drag from ramp-up costs is compressed into a shorter, more visible period rather than dragging on indefinitely. The rights issue is the funding side of that scope decision. 24 billion rupees raised in October 2024, specifically to fund the resort's project company, followed immediately by a 10-for-1 share subdivision, which is a liquidity and accessibility move rather than a value creating one on its own. It doesn't change fundamentals, but it makes the stock more accessible to retail investors following a large capital raise. The scope of the NEV entry is also a deliberate hedge. JKH is leveraging its existing supermarket footprint to install EV charging infrastructure, effectively cross-subsidizing a new business off an existing asset base rather than building distribution from zero. JKH operates across 7 industry groups: transportation, consumer foods, retail, leisure, property, financial services, and an other bucket spanning IT and plantation services. That's about as textbook and unrelated diversification conglomerate structure as you'll find in this market. And it raises the classic question: does the parent add value Or is this a conglomerate discount waiting to happen? The annual report's answer is resource allocation discipline. You can see it in the portfolio moves this year. Divesting a 37.6% stake in T smallholder factories as part of regular portfolio review, while simultaneously funding 2 nine-figure dollar new ventures. That's active portfolio management, not just holding everything indefinitely. Pruning low conviction stakes to fund high conviction ones. Where diversification is working. Retail and consumer foods delivered EBITDA growth of 25% and 34% respectively this year, becoming genuine cash generators. Financial services, through Nations Trust Bank and Union Assurance, grew EBITDA 17% and is arguably the most stable, repeatable earner in the portfolio. Where is currently a drag. Leisure EBITDA fell 50% headline, entirely attributable to CoDSL's ramp-up costs. Strip that out, and underlying leisure EBITDA was down a much more modest 8%. This is the execution test of any diversification strategy. Can new capital-intensive bets be funded without starving the mature, cash-generative businesses of investment? On this year's evidence, yes. Supermarket outlet expansion accelerated in the second half of the year, even while Code DSL absorbed billions in ramp-up costs. Structurally, JKH restructured its governance model this year, moving from centralized board committees overseeing all listed subsidiaries to separate entity-specific board committees for each listed subsidiary, with the parent company committee retained for group-wide alignment. That's a deliberate scope decision. As the portfolio scales and diversifies, decentralized oversight scales better than centralized control. On capability building, the group rolled out a revised competency framework, success drivers, across the organization, tying individual performance reviews to it. Combined with the Octave Analytics Academy, which has now trained over 440 participants, this reads as a deliberate attempt to build repeatable, portfolio-wide capabilities, rather than leaving capability building to each business unit in isolation. On culture, the One JKH Diversity and Inclusion Program is worth flagging, honestly, rather than glossing over. The group openly disclosed it will miss its original 40% female workforce participation target by the 2025-26 deadline and has pushed the target out to 2029-30. Transparent disclosure of a missed target is itself a leadership and culture signal. It's consistent with JKH's 4-year track record of scoring full marks on corporate transparency. Leadership continuity also matters here. Christian Balindra, as chairperson CEO, is steering both the resort and terminal bets to completion in the same tenure that saw the rights issue and governance restructuring, meaning strategic accountability for these bets sits clearly with one leadership team, not diffused across a transition. Now to the numbers, because strategy without financial discipline is just storytelling. I want to be precise here about two different pictures the report gives. Reported group results and underlying results excluding co-DSL. They tell different stories and both matter. On a reported basis, group revenue including associates grew 11% to Rs 354.8 billion. Recurring EBITDA grew a modest 4% to Rs 45.7 billion, and recurring PBT actually fell 11% to Rs 14.7 billion, with profit attributable to shareholders down 39%. Read on its own, that looks like a weak year. But the report is explicit that this decline is driven by CoDSL's pre-opening, ramp-up, and operating costs, plus newly recognized depreciation and interest expense once the Cinnamon Life Hotel opened in October 2024. Strip CoDSL out and the picture reverses. Recurring EBITDA, excluding CoDSL, grew 12% to Rs 50.4 billion, and recurring PBT, excluding CoDSL, grew 60% to Rs 22.9 billion. That gap between an 11% reported decline and a 60%